foreign investors are pulling out billions of dollars and selling heavily. GDP growth is slowing down, and now even corporate profits are under pressure because of inflation and weaker demand. Sounds scary, right? Mutual fund has experienced a negative return in last year ranging from 10% to 20% under various key. Obviously, those who have invested for the first time in last 1 year in mutual fund, either through one-time investment or SIP, are wondering what is happening and are clueless about what to do with their investments. In the next few minutes, I will show you what smart investors does. Typically, mutual fund investors expect stock market to deliver 15 to 20% return year on year. However, this is not the way market operates. They often move in waves, providing good return for the few years followed by a challenging year or two. After this downturn, the market usually resumes their upward trend. For example, in the first 2 years, you might have gained 30% returns. In the third year, you could experience a negative return of 10%, followed by a positive return of 20% in the fourth year, and so on. In next 10 years, the average return works out to 15 to 20%. So investors with a long-term SIP should not worry for the short-term correction for year or so. Despite the slowdown, India still has the highest GDP growth among major economies. Yes, growth has slightly slowed, but let's put things in perspective. India's GDP is still growing at 6 to 7%, while major economies like US, Europe, and China are struggling with 3 to 4% growth, and some are even in recession. Indian economy is resilient, driven by a strong domestic consumption and a booming middle class. Domestic investors are now the backbone of the stock market, reducing dependency on FIIs. So, should you stop your SIP? The answer is big no. Here are four reasons why stopping your SIP is a big mistake. 1. SIPs work best in market correction. When market falls, your SIP buy more units at lower prices. This is called rupee cost averaging, and it's what make SIP a powerful tool. Number 2. FII selling is temporary. FII comes and go. They sold in 2008, 2013, 2020 and 2022. And guess what? They came back when India's growth story remained strong. Number 3. Corporate profit will rebound. Short-term pressure exists, but corporate profit moves in cycle. With India's growth, earnings will bounce back. Number 4. The market reward patient investors. History shows those who have panic and exit regret later, while those who stay invested create wealth. Instead of stopping the SIP, here is what you should do. Keep investing. The best time to invest is when others are fearful. Increase your SIP if possible. If markets are falling, you are getting a better deals. Ignore the noise. Don't focus on daily news. Look at the bigger picture. Review your portfolio and don't panic. If your SIPs are in good funds, stick with them. India's story is still intact. Our economy is growing, our businesses are expanding, and domestic investors like you are becoming the backbone for the stock market.